Hi, this is Alvin from Dr. Wealth. The three local Singapore banks have just announced their third quarter results in 2022, and the results have been fantastic because their earnings have grown more than 30% compared to a year ago in third quarter 2021. And the improvement is across the board, as you can see in the slide here, right? Whether it's DBS, OCBC, or UOB, it is like they move in tandem. Their performances are more or less the same, right? In terms of revenue growth, is at least 20% and above, and earnings growth at least 30% and above. So in this video, I want to give you a breakdown. Where did this growth come from? And most importantly, are the banks at the right price to buy? Okay, so let's go on to the next topic, which is about their interest income, because for a bank, majority of their revenue should come from lending, right? That's what a bank usually exists to do. But of course, a bank don't just lend money today. They have wealth management arm, they have insurance arm, they can also have trading income, they also can have bond income, investment banking. So there are many ways to make money in the finance industry, and the banks increasingly have many segments. But we can separate them into two main segments. That means the first segment is what we talk about, loaning money, right? That is the interest income. And then the other part, of course, is the non-interest income. So you can group the rest of the banking activities into the non-interest income segment. And you can see that the growth really come from the interest income, because in a rising interest rate environment, banks now can charge higher interest on the loans that they lend out, and that is where majority of the growth came from. You can see UOB was up 39%, while OCBC and DBS were up 44% in terms of their interest income growth. And it is their non-interest income that were the laggards. You can see that even for OCBC, the non-interest income actually went down 4%, while UOB and DBS at least is still a positive growth, but it's not as high as the interest income growth. And that's why the overall growth was very healthy. You see the 20% gain, or even 30% gain for UOB when it comes to the revenue growth, right? So that is actually what is powering the banking revenue growth in third quarter. And with the interest rate expected to go up even further, we should expect Q4 to be another smashing quarter for these three banks as well, right? So I guess investors are expecting the results to be better and better, even into the next year, 2023. And this is another way to look at the interest income, right? Because for banks, one of the key metric is the net interest margin. That means based on the interest rate differential, right? Because the bank will pay interest on deposit, and then they will lend out and charge an interest on the borrowers. So this net interest margin is the difference. Okay, so you want this margin to be as large as possible, right? Then the bank will make more money. And in this case, you can see that OCBC broke the record, right? It has a more than 2% net interest margin. So that is something that is doing better than the other two banks. And it has also gained the most, right? The change from a year ago was plus 0.54%. But DBS and UOB, they are not far, right? Even though they never hit that 2%, they're very close. DBS at 1.9% net interest margin, and UOB at 1.95% net interest margin, gain about 0.4 to 0.5% from a year ago, right? So if you don't nitpick, actually they are very similar in terms of their performances. Next up, we look at the two key banking metrics. This is more like whether they are strong fundamentally, right? So the first one is non-performing loans, okay, the column number 1. You can see DBS is at 1.2, OCBC at 1.2, and UOB is slightly higher at 1.5. So what is non-performing loans? That means they earmark some of the loans that they think that may default, right? Or they have met a certain definition that classify them as non-performing loans. Okay, it doesn't mean that the borrowers are not going to return money. It's just that maybe they have not met certain payment obligation, right? Depending on how the bank classify it. Okay, so of course, lower the better. So in this case, DBS and OCBC are relatively better than UOB. And the last column is capital adequacy ratio, right? This is the tier 1 ratio. So you want this ratio to be as high as possible, right? But not too high such that it make the bank very conservative. Okay, so how to understand this ratio is basically what is the chances of a bank running out of money, okay, based on the amount of money that's being lent out. So you want to have a conservative enough adequacy ratio, but not too high, right? Because too high means that you are not aggressive in lending out money, and too low means that you have been too aggressive in lending out money. That puts the bank at risk. Okay, so you can see again, more or less they are around the same region, right? 12.8 for UOB, up to 14.4 for OCBC. Okay, and DBS at 13.8. So not much difference to talk about, and they are definitely way above the requirement by the Monetary Authority of Singapore. Right? So they are pretty safe in that sense, right? And this is the DBS dividend announcement. So they have announced another 36 cents dividend for quarter 3. For UOB and OCBC, they only announce their dividend twice a year, right? So every half yearly result. So this third quarter, they are not releasing any dividends announcement, but DBS on this hand were giving out quarterly, right? So they've been giving out 36 cents first quarter, second quarter, and third quarter. I got a feeling, okay, this is just my hunch. I think that DBS might raise the dividend in quarter 4. Okay, so provided the results are going to be good in Q4, which I'm pretty much confident because the rate hikes is still ongoing, and chances are they will smash the record, may even be higher than 30% profit gains compared to fourth quarter last year, right? So it remains to be seen, okay, but let's see whether I'm right on that. And this is the dividend yield. Okay, so based on the price that's stated there, right? Because price will fluctuate, okay, and the corresponding dividend yield is for these banks are above 4%. So you might be wondering, right? Now bond yields are like 4+% bills, okay, the treasury bills, okay, you can get 4+% cut off like what the last tranche did, and there are rising yields that you can effectively get more bang for your buck. Why would you want to buy a dividend stock? Why would you want to buy a bank stock, right? So the thing is that you are not just going to get dividend gains. You might possibly get capital gain when you buy these bank stocks as well, right? Because these bank stocks does benefit from rising interest rate environment. As we have seen, it has a very big boost to their income and their revenue, and that means that the value of these companies are going to go higher, and if share price reflect their fundamental, share price should go higher, and that's where you get your capital gain. So it's not just for the dividend. So these banks do have some capital gain potential, right? Of course, if you want to play safe with your money given these tough times, right, then of course going for those capital guaranteed investments would be safer. Okay, otherwise, these banks' stocks may worth a consideration if you are one that is looking not just for the yield but also the capital gains. And let's look at the valuation, right? So this is the key thing, okay? So which bank can we still invest in, okay? So I would like to look at this price to book ratio, right? Their trading range over the past 5 years. This is actually over the 10 years. This is compiled by CGS-CIMB, okay, and taken from some of the data in company reports as well as Bloomberg. So they plot this chart. So how you read this is that you can see that the average price to book ratio that DBS has been trading at is about 1.3x in the past 10 years. And you learn in statistics class that there's this concept called standard deviation. That means how much it goes away from or deviates away from the average, right? So there's 1 standard deviation, 2 standard deviation. So if you look at the blue line in the chart itself, that is the plot of the price to book ratio, the value, how it changes over time. Because as the share price changes, this price to book value will change, because price to book value consists of price itself. So this ratio will actually change every single day. And if you take a look now, DBS is trading at about +1 standard deviation. So if you ask me, it is on the more overvalued side, right? If it's at average, it is fairly valued, and it is at -1 standard deviation is undervalued. So it's more on the overvalued side at this point in time. And let's look at this is from UOB, right? It might be a bit difficult to see, but let me just blow it up for you. Right, so this is 5-year range. Okay, just now you saw for DBS was a 10-year range. Okay, so I would say minimally I will set a 5-year range, and this screenshot is taken from Tiger Brokers, the app itself, and you can see this is for UOB. Okay, this is for UOB, and the average price to book is at 1.16, and now the price to book is at 1.18. So it is fair value, okay, because it's trading very close to the average price to book ratio in the past 5 years. Okay, so I would say that DBS is overvalued, UOB is fairly valued. And let's then look at the last one, right, which is OCBC. Again, we look at the price to book ratio in the past 5 years using Tiger Brokers. Okay, let me blow it up for you again. Right, so average is at 1.12. The current price to book is 1.02. So it is slightly below the average. And the -1 standard deviation is 0.91. Right, so it is somewhere in between the average and the -1 standard deviation. So of all three, OCBC looks like it is the cheapest. Alright, it is the cheapest, even though it is not at -1 standard deviation. But if you really want to buy a bank stock that's undervalued, then it is likely this OCBC would pass the test. Okay, so in summary, banks are definitely benefiting from the higher interest rate environment, as you can see from their very strong Q3 performances, which I would expect that Q4 will be good, right? Maybe until next year Q3 things start to stabilize, right? Provided the interest rate hike has also stabilized, right? The hike stop going up so aggressively, and also the banks will start to lap their results, their 1 year results. Okay, so it will continue probably in the next few quarters, I would say. And more upside because the hikes are still going on, right? The Federal Reserve recent speech was very hawkish, and it is very likely that rate hikes will continue. Okay, so banks could benefit, I would think, at least for another 6 months. Okay, at least for another half a year. And I also expect the dividends to be raised because as the earnings go up significantly, they will have more capacity to distribute higher dividends. And these three banks have historically shown that their trend, they have an upward trend in their dividend distribution over the last 1 or 2 decades. Okay, and lastly, the three banks, in terms of fundamentals, in terms of performances, very little differences. They usually perform as a group, but in terms of valuation, OCBC is currently the cheapest of the three, in my opinion. Right, so don't take this as financial advice. Okay, please do your own due diligence, do your own homework. If you want to make an investment, make sure that you have really decided it properly. Okay, so this is something I hope that is useful for you. Right, if you like this video, please give me a thumbs up, as well as subscribe to this channel so that you will not miss another analysis like this. Okay, this is Alvin. Thank you for watching. Goodbye.